Let me tell you something that took me years to understand, and it changed everything. Most traders think that success comes from finding the right setup, or mastering the right pattern, or learning some secret technique that the professionals know. But that is not where success comes from. Success in trading comes from understanding your own mind, and more specifically understanding how position size affects your ability to think clearly. I spent decades working with traders, successful ones, struggling ones, brilliant ones who failed, average ones who succeeded, and I noticed something consistent. The traders who survived were not necessarily the smartest. They were not the ones with the most complex systems. They were the ones who understood the relationship between risk and psychological clarity. Let me explain what I mean. When you first start trading, you bring certain beliefs with you. Beliefs about what success looks like. Beliefs about what it means to be good at something. In most areas of life, bigger is better. More effort equals more results. Intelligence should be rewarded. Hard work should pay off. These beliefs are deeply wired into us. So when we come to trading, we naturally assume the same rules apply. We think that bigger trades mean we are more committed, more confident, more serious about making money. We look at a small position, and we feel like we are playing it safe, like we are not really trying, like we are being timid or afraid. And we look at a big position, and we feel powerful. We feel like we are finally doing something that matters, like this trade could change our account, change our life. But here is the problem. The market does not care about your feelings. It does not care about your confidence. It does not reward effort or intelligence or commitment. The market simply moves according to probabilities, and your job is to align yourself with those probabilities, not to prove something, not to make a statement, but to execute your edge over and over again without interference. And interference comes from emotion, and emotion comes from risk that is too large for your nervous system to handle. Let me describe what happens inside your mind when you put on a trade that is too big for you. At first, you might feel excited, energized. This is it. This is the trade that is going to make a difference. But then the market moves. Maybe it moves against you slightly, or maybe it moves in your direction but then pulls back. And suddenly something shifts inside you. Your breathing changes, your focus narrows. You start watching every tick. Every candle becomes personal. Every move feels like it is saying something about you. This is not trading anymore. This is survival. Your brain has detected a threat, not a physical threat, but a threat to your sense of security, your sense of self, your sense of being okay. And when your brain goes into survival mode, it stops being rational. It stops following rules. It starts making decisions based on fear and urgency. You start thinking thoughts like this: I should have taken profit when I had the chance. I cannot afford to lose this trade. Maybe I should move my stop just a little bit. Maybe I should get out now before it gets worse. These thoughts feel logical in the moment. They feel like you are being smart, protecting yourself, making the right decision. But they are not logical. They are emotional reactions disguised as logic. And the reason they are happening is not because your strategy is wrong. It is because the risk is too large for your mind to handle objectively. Here is something most traders do not understand. Your ability to follow rules is not a character issue. It is not about discipline in the way people think. It is about whether your nervous system feels safe enough to let you follow the rules. When you are calm, following rules is easy. You know what to do, you trust your system. You execute without hesitation. But when you are afraid, following rules becomes almost impossible because fear overrides logic. It is designed to. That is how survival works. If you are being chased by a predator, you do not stop and think about the best strategy. You run. You react. You do whatever feels necessary in the moment to survive. And when your position size is too large, your brain interprets a losing trade as a predator. It interprets drawdown as danger, and it takes over your decision-making to protect you. This is why traders make the same mistakes over and over, not because they do not know better, but because they are trading in a state where their brain will not let them do better. Let me walk you through the most common mistakes that come from oversized risk. First, hesitation. When the risk is too big, you start second-guessing your entries. You see your setup, you know it is valid, but you hesitate, you wait for more confirmation, you talk yourself out of it, and then the trade works and you feel frustrated, angry at yourself, so you promise to take the next one, but the next one also feels risky, so you hesitate again, or worse, you take it late after the best entry is gone, and then you get stopped out. This creates a terrible cycle. Second, moving your stop loss. This is one of the most destructive habits in trading. You place a trade with a logical stop, but then price approaches your stop, and suddenly that loss feels unbearable. You cannot accept it, so you move the stop a little further away. You tell yourself it is because you believe in the trade, but the real reason is that the loss is too painful to accept. Most of the time, the trade does not come back, and by moving your stop, you turned a small loss into a larger one. Third, cutting winners early. When you have a big position on, profit feels fragile. You feel this intense urge to lock it in before the market takes it back. You exit too early and watch the trade continue without you. This is a position size problem. Fourth, holding losers too long. When a trade goes against you and you are risking too much, you freeze, you hope it will come back. You hold through your stop. You hold because accepting the loss feels like failure. By the time you finally exit, the loss is much larger than it should have been. Now let me tell you what happens when you trade with a smaller position size, a size that feels almost too small. First, you become emotionally neutral. The trade stops being personal. It is just another execution. Second, you can follow your rules without internal conflict. Third, you let probabilities play out. Trading is a probabilistic game. Your edge is that over a series of trades, your system produces more profit than loss. But for that edge to work, you have to let it work. You have to execute the system over and over without interference. When each trade is just one in a series of hundreds or thousands, you stop trying to control the outcome. You stop needing to be right. You stop caring whether this specific trade wins or loses. You just execute and let the numbers do what they are designed to do. Fourth, consistency becomes possible. With small size, you can trade the same way every day. You build a track record that is based on process, not luck. Over time, that consistency compounds. Let me talk about ego for a moment. Trading with small size feels like you are not trying hard enough, like you are settling, but this is your ego talking. The market rewards the trader who can remove ego from the equation. The trader who can accept small wins and small losses and just keep going. Trading is not personal. The market is not testing you or judging you. When you take a big position, you are turning a probabilistic event into a referendum on your worth as a person. That is a game you cannot win. Traders gravitate toward big positions because they think it gives them control. But this is an illusion. You do not control the market. All you control is your execution, your risk and your response. The bigger your position, the less control you actually have because your emotions interfere. Small size is actually reclaiming control, control over your mind, your process, and your ability to stay in the game long enough for your edge to work. The goal is not to make money. Not at first. The goal is to survive. Survival means staying in the game, not blowing up your account, and not quitting because you are too emotionally damaged. Survival requires humility and patience. When you trade with big size, you are prioritizing results. When you trade with small size, you are prioritizing survival. Over time, survival leads to profit. Compounding is what happens when you can execute consistently over a long period without blowing up. When you are trading too big, you interrupt the compounding process. But when you trade small, you create the conditions for compounding to actually work. Your edge is not about being right. It is about what happens over a series of trades. A good system might win 50%, 60%, or 70% of the time, but even then you lose 30%. If you are trading too big, those losses will destroy you. But if you are trading small, those losses are just part of the process. They don't hurt, they are just data points. When you can accept losses as part of the process, you stop trying to avoid them. You stop moving your stops, you stop hesitating. You stop cutting winners early. You just execute and let the probabilities play out. Successful traders are the ones who are still here, still trading, still consistent, still calm. They are durable. Durability comes from trading in a way that does not burn you out or trigger your worst impulses. Excitement is overrated. What you need is calm, clarity, and consistency. You get that by trading at a size that feels boring, a size that focuses on execution instead of outcomes. Trading is about executing a process that has an edge. Your job is to execute that process as cleanly as possible without interference. The only way to do that is to remove emotional intensity by trading at a size that does not trigger your survival instincts. Measure success differently by how well you executed, how calm you stayed, and how closely you followed your rules. If you execute well, the profit will come. If you cannot execute well, the profit will not last. When you finally embrace small position sizes, you feel free from anxiety and the fear of ruin. You can place a trade and walk away. That freedom changes everything. When you are free from fear, you can finally trade the way you are supposed to. Trading becomes a calm, methodical execution of a process. Trading is hard enough without making it harder on yourself. Create an environment where good trading is possible. That environment starts with position size. Trade small, smaller than feels significant. Small enough that you can stay calm and follow your rules. Survival is the foundation. If you can survive long enough with enough consistency, the results will take care of themselves. That is the truth about position size, and it will change your trading if you let it.